So there are three things in total in this part 17. Three things in total you have to know. Accounting principles, bookkeeping and accounting, and lastly, interested parties. Okay, they are not related to one another. They are not related to one another. Okay, these three topics are independent. Okay, so we are going to begin with accounting principles. Okay, accounting principles. So first page, okay, first page of the notes. On the top of this page, you see two lists of things, correct? You see two lists of things. On the left list, the list on the left, you have the list of items. These items are known as accounting principles. They are also known as accounting concepts. Okay, this entire part 17, no numbers at all. Okay, no numbers are involved at all. All are theory. Okay, and many students, in fact, they don't like the accounting principles. But you still have to learn. You still have to learn. Sometimes in theory question, they ask you for maybe what is the meaning of prudence principle? What is the meaning of duality principle? Yeah, they may ask you questions like those. Okay, so what are accounting principles? Accounting principles, or you call them as accounting concepts. They are the rules to follow when you do your accounting. Okay, rules to follow when you do your accounting. Okay, in the future, if you do study accounting subject, for example A level, or you study degree in the university, okay, then you would learn more about these principles. Okay, for IGCSE, they just touch these accounting principles on a surface level. Okay, that means they don't talk much about this principle in detail. They don't explain much. Okay, they just explain at a brief level. Okay, they explain not a lot. Okay, so later we are going to go through one by one. This accounting principle we will go through one by one. In fact, you have seen some of those here earlier in the earlier topics. You have seen this before. You have seen this before. You have seen these three before. Okay, but the rest you have not gone through them with me. And we are going to see it in the part 17. On the right hand side, you have another list of things, but they are not accounting principles. This list of things, they are known as accounting objective. They are known as accounting objective. So accounting objective means the goals that you want to achieve when you do your accounting. The goals that you want to achieve when you do your accounting. Okay, so there are four things here: comparability, relevance, reliability, or you call it faithful representation, and understandability. Okay, you must know which are accounting objectives and which are accounting principles. Okay, don't get these two groups of terms mixed up. Okay, don't get these two groups of terms mixed up. Don't, because certain questions ask you, what among the following, which are the accounting objectives? If you choose accounting principles, then you are wrong. Okay, they give you a list of things that is made out of accounting objective and principle. They ask you which are the accounting principles. So make sure you don't choose objective. Okay, so you must know very well which are accounting objective, which are accounting principles. Okay, don't get them mixed up. Don't get them mixed up. Let me erase. Okay, so let's look at accounting principle first. Okay, one by one. Below these two lists, you see a lot of tables. You see a lot of tables. Each table represents an accounting principle. Each table represents an accounting principle. We look at the first table. In fact, for those that you have seen earlier in the earlier topics, for those principles that you have seen in the earlier topic, I would not talk much about them. Okay, I will not talk much about them. For those that you have not seen before, I will go through in detail with you. First table, First table, a very small table. The blank here in the first row, you write duality principle. Can write duality principle. You saw this in part 3, okay, when we started the topic of doing double entries. Okay, at that time we have this principle which tells that for every transaction in business, there will be two effects. There will be two aspects or effects where you have to make two entries. You must make two entries for every transaction. And the two entries are debit and credit entry. Okay, as simple as that. The rule to follow when you do accounting, one of the rules, duality principle. Okay, you have to do debit and credit. At least one debit, at least one credit for a transaction. Okay, so that's duality principle. Don't ask me why you have to do debit and credit. Okay, that's the nature of the subject. Like in mathematics, why do you do plus? Why do you do minus? You never ask, right? Okay, that's the nature of the subject. Okay, so here doing double entries are the nature of the subject, and the rule to follow is duality principle. If a question asks you what is meant by duality principle, then you tell them this line. Okay, tell them this entire sentence. Next table, you write. This is something you have never seen before. Money measurement principle. You write down. The reason I don't type for you is because when you write it down yourself, you can remember better. Then you never see my notes that are complete, right? Okay, my notes are always with blanks here and there. Okay, my purpose of doing so is to let you do some writing when I'm doing the topics. Okay, money measurement principle. So the meaning here means, the principle here means you can only record things that you can measure. You can only record things in your accounting that can be measured with the dollar sign. That can be measured with the dollar sign. That means you can put a value upon that item, then only you record it in accounting. And here the point is you must know what are the things that cannot be recorded in accounting simply because you cannot measure them with the dollar. Okay, I will give you some examples. You will understand this very well. This is a very easy principle, very easy accounting principle. If they ask you for the general meaning, they ask you what is meant by money measurement principle, then you give them this line. You give them this line as the answer. In accounting, only transactions that have a definite monetary value are recorded. Have a definite monetary value means you can measure it with dollar, with value. Okay, you can put a value upon something. Okay, that's what we call as definite monetary value. So Adeline, this is page number 398. Okay, this is page number 398. For the first few minutes you have missed, you may have to watch the videos. Okay, but I will send later. Now, let's look at some examples of things which you cannot measure objectively. You cannot tell that this thing is worth how many dollars. Okay, you cannot say so for this item. First example, you are in a good location for business. You are in a good location for business. Okay, so can you measure the benefit of being in a good location? Not, you cannot. Okay, you cannot measure reliably and objectively how much it is worth when you are in this good location for your business. Good location, for example, your business is in the city center instead of being in the rural area. Okay, so being in a good location is an asset to us, right? Because that helps us a lot in our business in generating profit. So this is something. This is the example of some things that you cannot measure reliably and objectively with monetary value. You cannot tell people how much is it worth for being in this location. So this is something you ignore in accounting. In order to comply with money measurement principle. Okay, in order for you to follow this rule of money measurement principle, you ignore this when you do accounting. You don't put this into your accounting. Okay, being in a good location. Another example, it must be money. No, something that you can measure. For example, you buy a machinery. Do you have a value to it? Yes. If it has a value, then you can put this into accounting. Yeah, you must be able to measure it with money. Okay, otherwise you cannot put it in accounting, right? For example, you sell goods to your customer. Can you measure that? Yes. When you sell goods to your customer, we call it as sales. It has value, so you can put it into accounting. Okay, as simple as that. You pay salary to your workers. Can that be measured? Of course. So it has value, then you can put it into your accounting. Simple. Now we are going through some things that you cannot measure. Okay. First example is good location in a business. Now, second one, having good business reputation, or you call it image. Okay. You have a good business image. All the people like your business very much. For example, you always use Gmail, you always use Google Drive, you always use Google Classroom. I don't think you like Google Classroom, okay? It is those teachers who ask you to use. But many people around the world use the products of Google, so their image is very good. Okay, their reputation is very good. Can you measure the reputation of a business? Can you tell people that all the customers like us very much and that is worth $1 million? Our reputation is worth $1 million. Can you tell people so? Of course cannot. Okay, we cannot measure reputation with dollar, right? So once again, reason is the same. Cannot measure the reputation reliably and objectively with monetary value. You cannot tell people that your image is worth $10,000. Okay, because we simply cannot measure. So something like this we ignore in accounting. Okay, in order to comply with the rule of money measurement principle. Okay, accounting principles are the rules that you have to follow when you do accounting. Okay, principle means rule. Now, next example. Okay, the question that you ask is about another thing. How? So I have forwarded the question to everybody. This question you ask is about how come people would still say that their business reputation worth a lot of money. No, people would say that their business is worth a lot of money, not business reputation. If you see this same sentence that you can quote from somewhere, then you send to me, okay? No, people will say their business reputation is worth a lot of money. People will say their business is worth a lot of money. Business is worth a lot of money, not the business reputation. Okay, business is worth a lot of money, not business reputation. If you see this line somewhere, you quote for me and you send to me, okay? I will correct it. I'll explain to you. Okay, now last one, having good customer relationship. Once again, can you measure the relationship with someone with dollar sign? Can you tell that your relationship with your parents are worth 10 million? Can you tell that your relationship with your brothers and sister is worth 10 million? Of course cannot. Cannot measure relationship with dollar. Cannot measure relationship with money, right? So again, cannot measure such thing. So you ignore. Okay, so you ignore. Okay, I give you one more example. All the three things here that I have as examples are the good things, right? Are all the favorable things, right? I give you one bad example. Your business is about having a food store in the pasar malam. Okay, your business is about running a maybe burger store in the pasar malam. what are the factors that affect the businesses in the pasar malam? Of course, the weather, right? Okay, so you write down bad weather. I write in Malay lah, okay, pasar malam. Okay, in Malaysian context, okay, bad weather from pasar malam. So it's a bad thing, right? It's a bad thing to our business, right? Bad weather for pasar malam. Can you measure? Can you measure the bad effect of the bad weather? Can you measure with the dollar sign? Once again, you cannot measure the consequences of having bad weather. So once again, something like this, you ignore. Okay, later I will show you some exam questions, okay? Then you would know how to apply what you are going through with me to those questions. Okay, no worries, it's very easy. Now, that's money measurement principle. Only things that you can measure with money, then only you put into your accounting. Those that you cannot measure, like those here, then you don't put into accounting. Very simple. Okay, now last table on this page. You write, this is also very simple. Business entity principle. Business entity principle. So let's see. This principle tells you that when you do accounting, you must be clear about the nature of the transaction. You must be very clear about the nature of the transactions that you see when you do accounting. That means, to further explain this, it tells you that you must know what are private in nature, what are the things that are business in nature. That means, what are the transactions that you are seeing that are related to your something personal, or is related to something that's related to the business. Okay, so let's see the general meaning. If the question asks you what is the meaning of this business entity principle, you tell them this line. Business transactions and the owner's private transactions are recorded separately, okay, or you call it differently in a business accounting system. Okay, for example, here are three examples. Okay, so must remember, this principle is about knowing what is private in nature, what is related to the business. Very simple. Okay. The first one, use personal money to pay for child's tuition fee. Is the tuition related to the business? Of course, no. Tuition is not related to the business. Is the personal money related to the business? Of course, no. It's not business money. It's not money from the cash and bank in the business. So something like this, ignore. Okay, something like this, you ignore. Okay, in order for you to comply with business entity principle. Another example, a different example this time. You use business money, that means you use the money from the business to pay for child's tuition fee. This is partly related to business, because you are using business money. And this is partly related to something private because you pay for your child's tuition fee. So for something like this, you know what to do. This is about drawings. Okay, so you must know what to do. You must debit drawings, credit cash and bank. Okay, credit cash or bank. Ensure that you don't debit tuition fee, because tuition fee is not an expense in the business. Okay, you must debit drawing. If you debit tuition fee, it means that in your business you have spent on something known as tuition fee. okay, which is not logical. You don't spend tuition fee in your business. Okay, so yeah, so this again about knowing what is private and what is related to the business. Okay, being clear about, you must draw a very clear line. Okay, a clear line that separate those private from those in business. Use business money to pay to business supplier. This is fully about business. This is 100% about business. You are using business money to pay to the business supplier. Nothing private in nature. Nothing private in nature. So you have to credit cash or bank, debit trade payables. These are just some examples, okay, to demonstrate to you the different transactions that you will see in the exam. Okay, so this is business entity principle. Very simple. What do I mean by ignore? Ignore means you don't record in accounting. Ignore means you don't record in your accounting. Okay, because it's fully personal in nature. You use personal money to pay for child tuition fee. Everything is private, nothing related to the business. So ignore means you don't record in accounting. Okay, next page, first table on the top here. Okay, this page 399, page 3999, sorry, page 399. Okay, there are two tables here. The one on top here, you write consistency principle. You have seen this before, consistency principle. In many of the earlier topics, like depreciation in part 7, like the debt in part 8, you saw this principle, okay? You saw this principle, consistency principle, in the part 7 and 8. You can look at this part 17 as a summary, the summary of all the accounting principles, okay? So consistency principle means doing the same thing every time, right? That means doing something the same way every time, consistent, being consistent. If they ask you for the meaning, of a consistency principle, you give them this line as the answer. Okay. And sometimes they ask you what is meant by consistency principle in the context of depreciation. I show you an example. Okay, you write down together. They ask you, okay, write down. Okay. How is charging depreciation an application of consistency principle? Basically, it's asking you how is charging depreciation related to this consistency principle. Okay, they're asking you how is charging depreciation an application of the rule of consistency. If they ask you such question, it means that they are not asking you for the general meaning of consistency principle. If they ask you for the general meaning, they simply ask you what is meant by consistency principle. You give them this line. Okay, now I'm guiding you on how to make use of this table. Okay, and if they ask you how is charging depreciation an application of following the rule consistency, then your answer would be different. Your answer would be this line. Using the same depreciation method for each category of NCA each year. Okay, if it's a 1-mark question, then you can stop here. If it's a 2-mark question, then you continue to write until the end. Okay, so that's how you make use of the lines here. I know it's challenging. Okay, your task would be to knowing what to write if they ask you such question. Okay, so the more questions you do, sooner or later you can memorize these lines. Okay, but for now it would be challenging. Okay, and this principle is also related to doubtful debts. It's also related to doubtful debts. Once again, if they ask you how is charging depreciation and application of the doubtful debts, sorry, how is calculating doubtful debts and application of consistency principle? Okay, that means you replace this term with doubtful debt. Okay, how is calculating doubtful debts and application of consistency principle? Then your answer would be different as well. You have to tell how is doubtful debt and application of consistency principle. Your answer will be this line. Using the same method in determining the value of doubtful debt each year. So that's the answer. If they want you to continue to write, that means if it's a 2-mark question, then you continue to write the next line to ensure that income statement and SOFP can be compared fairly and reasonably. Okay, so this is how you make use of this table about consistency. If they ask you for the meaning of consistency principle, give them the first line. If they ask you how to apply this principle to depreciation, give them the next row as answer. If they ask you how to apply consistencies to that for that topic, then you give them this as the answer. Yeah, so you will see some questions on this from time to time. Next table is also a principle you have seen before. It's a very popular principle known as a cross principle. Synonym is matching principle. Okay, a cross principle means the same as matching principle. Okay, you have seen this many times. You saw it in part 6. You saw it in part 7. You saw it in part 8. You saw it in part 10. Okay, that means this topic is widely applied throughout the whole subject. Okay, so once again, the first row of the table, I give you the general meaning. Okay, if they simply ask you what is meant by a cross principle, then you just tell the meaning of this principle itself. So general meaning, answer is here. Another kind of question they may ask you is, so once again, a cross principle, you have seen it many times. Okay, I'm not going to explain in fully detail here. Okay, all the sentences here, I copy and paste from part 6, part 7, part 8, and part 10. Okay, you can refer to that if you want to. Here is a summary. Okay, all these lines I copy and paste from those earlier notes, part 6, 7, 8, and 10. Okay, just now I told you that if they ask you for the general meaning of a cross principle, you give them this line as the answer. If they ask you how is preparing income statement an application of accrual principle, your answer would be the same. Okay, it happens to be the same. If they ask you how is preparing income statement an application of matching principle, then you give them this line as the answer. And if they ask you how is accrual and prepayment an application of accrual principle, then your answer would be this. Okay, then the rest you know how to apply. Okay, if they ask you how is depreciation linked to accrual principle, your answer would be this. How is bad debt and doubtful debt related to accrual principle? Your answer would be this. And how is valuation of inventory? Remember, lower of cost and net realizable value about valuation of inventory that you learn in part 10. If they ask you how is valuing inventory an application of accrual principle, and then your answer would be this. Okay, I know it's challenging, but that's your task. Okay, that's your task to know what to write when you are given the exam questions. It will take you a bit of time to know how to write these lines without referring, okay, in the exam. Okay, so all this line you read yourself, okay? We went through in the earlier topics, okay, part 7, part 8, part 6, and part 10. Hold on, yeah. Let me see how many more before we start to do question. A few more, okay? We do until here, then that will be the end of the accounting principle. Then we go and do questions, okay, for accounting principle. One more, two more, three more. Okay, three more. Now let's see the next one. Okay, page 400, page 400. This is also an accounting principle that you have seen before in the earlier topics. In part 7, you saw this principle. In part 8, you saw this principle. In the part 10, you also saw this principle. Okay, I let you try. You look at the general meaning. Then you try to tell me in the chat box, what is the name of this principle? Okay, I give you maybe 20 seconds. Okay, good, Benjamin. Okay, the rest I let you try. What is the related principle here based on the general meaning? Very good. Prudence. Okay, prudence. We seldom do questions on accounting principles when we were doing the earlier topics. Okay, because I know one day when we come to here, when you see the summary of accounting principles, then after you have a bigger picture of the accounting principle, then only we do the questions, the related questions. Then I think it's more logical. So yeah, you're right. You go on and write prudence principle. Prudence principle. Okay, so I don't want to explain the whole table. You know how to make use of it. If they ask you for the general meaning, if they ask you what is meant by prudence principle, then your answer will be this. If it's a 2 to 3 mark question, then you give them another line. Okay, and the rest are about the application. Okay, how is charging depreciation an application of prudence? Then you give them this as the answer. If they're asking you about this, then you give them this as the answer. And also this. Okay, to be honest, I don't think I can find a way to help you to construct your own sentence when you are in the exam. Okay, if, for example, if they ask you how is charging depreciation an application of prudent principle, your answer would be this. You see, you read yourself, we do not want to overstate NCA and profit for the year. Can you find another word for any of the terms here? I don't think so. Okay, you can hardly rephrase this entire line. Okay, we do not want to overstate NCA or profit for the year. So and profit for the year. Okay, so you can hardly change any term of the line. That means you have to follow strictly. Can you replace the NCA with any other things? No. Okay, just write NCA. Okay, so just follow strictly. Just have to follow strictly. There's nothing much we can change about the answers here. Okay, so prudence principle table, you go through yourself. This next one is something you have never seen before. And now I have to explain this one. You write going concern principle. Going concern principle. 3 words, yeah, 3 words. Going concern principle. If you ask me where we are going, no, we are not going anywhere. Why they have the word going there, I also do not know. Okay, that's the term. That's how the term looks like. Going concern. Going concern is a term. You can look it up in the dictionary. You would know the meaning from looking at the dictionary. Going concern means that you intend to continue to run your business. You intend to continue to run your business. That means you don't intend to close down your business. You don't intend to close down your business. That's the meaning. Okay, you don't intend to close down your business. So let's see this principle. This principle tells us that if you wish to continue to run your business for the next 12 months, that means you don't have the intention to stop. Cease means stop, right? Cease means stop. So it also means that you don't have the intention to stop or reduce your scale of operation. Scale of operation means size of business. Okay, that means you don't intend to make your business smaller. You don't intend to stop your business. Then, okay, what you have to do is financial statements should be prepared on a going concern basis. Financial statements should be prepared on a going concern basis. Okay. One more term that I have to explain what is meant by going concern basis. Hold on, yeah. So I'm going to explain to you what is meant by going concern basis. In short form, I have written here GC basis. Okay, that's going concern basis. Okay, so let me repeat the first sentence again. The first sentence basically tell you if you want to continue to run your business, you don't want to close down your business, then you should prepare your financial statement using going concern basis. Basis means method. Okay, let me explain what is going concern basis. The word basis means method. What is going concern basis? I'll tell you soon. Okay, basis means method. Yeah, know this word first. Basis means method. Okay. Going concern basis, synonym is historical basis. Synonym is historical basis. Okay, so what is historical basis? What is the historical cost basis? What is going concern basis? The line highlighted in yellow is the meaning. The line highlighted in yellow is the meaning of going concern basis. It says that assets should be valued based on their purchase price. Purchase price means the price you actually paid for the assets rather than their realizable value. Okay. Realizable value, you write down another term for it. Realizable value means market value. Realizable value means market value. Okay, so I'm going to show you an example for this one. Okay, I'm going to show you an example for this one. Okay, so it says assets should be valued based on their purchase price rather than their realizable value. Okay, let's talk about a building. A building. A building is an NCA, right? A building is an NCA, right? Okay, let's say you bought the building 5 years ago. Right, you may write down the example, yeah, because you don't have example here. 5 years ago, you bought the building for 10,000. This is known as purchase price. Purchase price is also known as the cost. Okay, cost means purchase price. Okay, you bought the building 5 years ago for $10,000. Okay, and then every year when you present the building in your SOFP, building is NCA, right? Building is NCA. So you will present the building in your SOFP. Purchase price, purchase price. Cost means purchase price. PP is purchase price. I write in short form. When you present your building in your SOFP, you always take the cost minus the accumulated depreciation, right? You always measure it at cost, right? Okay. Do we care about at what price you can sell the building right now? Do we care about at what price do you sell the building right now? If you want to sell it off? No, right? We never look at the market price. Okay, when you do the accounting. So this is known as going concern basis. This is known as going concern basis, an example. Or you call it as historical cost basis. because we always make use of the cost. We always make use of the cost in the SOFP. So this is a building that I say you bought 5 years ago, right? Okay. Right now, that means right now, okay? Right now, it is worth maybe 80,000. That means it has increased in value. The building has increased in value by $70,000. Okay, so what do you call this as? This is the market value. This is the market value. That means if you sell off the building right now, you get 80,000. That's known as market value, or you call it a realizable value. Okay, market value is also known as realizable value. Okay, so let me repeat again. In fact, I have not fully explained. Okay, I have not fully explained to you. I'm just giving you the example right now. Okay, going concern principle is firstly it tells you if you wish to continue to run your business, you don't intend to close down your business, then you should prepare your financial statements using going concern basis. And then firstly, I told you that basis means method. Okay, so what is meant by going concern basis? Firstly, know the synonym first. Synonym of going concern basis is historical cost basis. Okay, that's the synonym. And this going concern basis tells you that all the assets that you record in accounting, you must record using the purchase price. Purchase price means the price you paid to buy it, rather than their realizable value. Realizable value means market value. So I just now I gave you an example here. A building which is an asset you bought 5 years ago. At that time you bought it for 10,000. So the 10,000 is known as the cost, the purchase price. Okay. And right now it is worth 80,000. 80,000 is the market price, or you call it the realizable value. Okay. So this going concern basis tells you that if you wish to continue to run your business, you should not measure the building at market value in your SOFP. You should not put 80,000 in your SOFP for the building, because you don't intend to close down your business. You must still measure it at cost, which is the 10,000. Yeah, as simple as that. That's going concern basis. Okay, you have to retain the 10,000 that you present in your SOFP. You must not show 80,000. That's what it tells, going concern basis. Okay. Okay, it's very complex. This is something very complex. Okay. And in the future, there are more to this. There are more to this accounting principle. Okay, if you learn accounting, if you happen to take accounting, you will learn more about this. Okay, but right now you just see how I explain. You try to understand as much as possible. Okay, just try to understand as much as possible. Okay, now what about on the other way around? The other way around would be you wish to close down your business. Okay, look at the next paragraph. If it intends to cease its business operation, cease means stop, okay? That means if you wish to close down your business, then you must not use going concern basis. You must measure all the assets at realizable value. Can see all assets should be valued at their realizable value. Okay, so this is the other way around. This is what you do if it's the other way around. Okay, you see, it actually makes sense, right? If you want to stop running your business, will you sell off all the things? Will you sell off all your assets? Agree, right? You will sell off, right? Because you want to close down your business. You would not use your assets anymore. You would no longer use your assets. So you might as well sell them off at the end of the day, right? Because you want to close your business. When you want to sell your assets, you must know the market value, right? You must know the market value, right? You should not simply sell your things at a price that you simply like. Okay, for example, okay, in Mandarin, in Malaysia, we have the term chin cai, right? Okay, that means you simply sell off your building at the price. Okay, I think it's worth 50,000, then I simply sell it at 50,000. Cannot, right? You would have lost 30,000. You cannot simply sell off your assets. You must know what it is worth, then only you sell to your buyer. Okay, so if you wish to close down your business, logically, you should go find out what is the market value for all your assets. Okay, at the same time, in your SOFP, all the assets that you present must be at the market value. Must be at the market value. Okay, instead of the going concern basis. Yeah, so this is going concern principle. This is going concern principle. You see the next line, realizable value. It tells you the meaning. Okay, existing selling price. Existing selling price means market value. Okay, existing selling price means market value. Yeah, so don't worry. The exam questions are very easy. Okay, very easily you can link to this principle and then you write the answer. Now, last one before we start to do the questions. Here you write, okay, one of you asked me, but when we solve our NCA, why do we still have to include the NCA in our SOFP? Now you see, when you have made the decision, about closing down your business, okay, at the point of time, for example, today, do not know what is wrong with your mind, okay, you decided to close down your business, okay, we decide to close down our business today. Do your non-current assets disappear straight away? Do your assets disappear immediately? No, right? When you have made the decision about closing a business, our assets don't appear, our assets still exist. Our assets do not disappear immediately, right? That's why upon the decision made about closure, you can measure all the assets at market value. Then you have to wait, right? You have to wait for buyers, right? So you will start to do advertisement about selling off your NCA and those things. Okay, so during that period of waiting, you should present your assets at the market value. Ishin, can understand? Because your assets don't disappear straight away when you have made the decision. So during the period of waiting for customers to buy, you can present them at the market value. Yeah, it's not weird. It's not weird. Ishin, it's okay. Yeah, that's something that you will do in the future. You will change all the values of the assets in your SOFP when you close down your business, when you wish to close down your business. Nothing wrong about it. Nothing wrong about it. Okay, when you wish to sell off your business, you will present all your assets at the market value. Okay, you will change all the amounts. Okay, now second last one. This is the second last one. You write realization principle. This is something you have not seen before. Realization principle. This principle is very easy to understand. It tells you when exactly do you record sales in accounting. Okay, when exactly do you record sales in accounting? That's what this principle tells us. Okay, so why is it important? Why is it important as to when to record sales? I give you an example. You run a very big business. Okay, and this very big business has a lot of branches throughout Malaysia. Your business has a lot of branches throughout Malaysia. Maybe a few in KL, a few in Selangor, a few in Johor, a few in Penang, a few in Sabah and Sarawak. A big business. Okay. Now, can you manage all the branches yourself? Of course, no. You must hire workers, right? You must hire branch manager, right? Okay. So assume that you hire a branch manager to manage a branch that is in Johor. You hire somebody to become the branch manager to manage a branch in Johor. Okay. So in a subject known as business study, we have a topic known as motivation of workers. You must know how to motivate your workers. So how can you motivate your branch manager? Maybe you give an incentive to your branch manager. You tell this branch manager that if you can hit the target, if you can hit sales target of maybe $1 million for 2021, for example, that means you set a target. You set a target for this branch manager. You tell this branch manager is your worker, yeah? Branch manager is our worker. We hire this person to become branch manager. So you tell this person that if you can hit, so I give you a sales target, 1 million. Okay, that means in 2021, if you can get sales amount of at least 1 million, then I will give you extra bonus for this year. Okay, you get what I mean? You hire a manager, you hire somebody to become a manager to help you manage a branch in Johor. Then you tell this person that if you can hit sales of 1 million during this year, then you will get extra bonus this year. Maybe an extra bonus of 10,000. Just example. So what would the branch manager do after knowing about the incentive? Branch manager, of course, will try his or her best to hit the 1 million target, right? Agree or not? That's why it's very important to know when exactly to record the sales. Okay, do you think that the branch manager would like to record the sales as early as possible? Of course, the branch manager would like to record the sales as early as possible, ASAP. Okay, the manager would like to record the sales as ASAP, especially when it's near the end of the 2021. Of course, right? Why? Because the branch manager would like to hit the 1 million target. 1 million target. Okay, that's why he or she would like to record it ASAP. So to prevent the manager from cheating, okay, to prevent somebody from cheating, there's a rule here known as realization principle. It tells you when exactly you should record sales and when exactly you should not record sales. Okay, let's see some examples. So here is the general meaning. If they ask you what is meant by realization principle, you give them this line as the answer. Let's read this together. It says that a sale occurs when the customer pays or when an invoice is issued for the goods or services. Okay, let me explain what this means. It tells you that you should record the sales when either of these two happens. When either of these two happens. That means whichever is earlier. Okay, when customer makes payments to us, at that time you can record the sales. Or when you have sent an invoice to the customer, at that point of time, you can record the sales as well. Okay, so when will you issue an invoice? Remember, when it's on credit. When you buy and sell on credit, you will see an invoice. Remember, you learned it from a topic long time ago. Okay, so let's see some examples. Let's see some examples to understand further. There are three types of selling goods, right? There are three types of selling goods. You may sell goods and collect cash on the spot. Okay, that means we get the immediate payment. We get immediate payment from the customer. The second one is also immediate payment from the customer. Immediate payment from the customer. The third one is selling goods on credit. Okay, there can be only three scenarios when you sell goods. You sell goods and collect cash on the spot, sell goods and collect check on the spot, or you sell goods on credit. Okay, customers will owe you for some time. Okay, so for selling goods and collect cash, when should you record the sales when you have received the cash. Okay, when you have received the cash, then you can record the sales. That's the point of time. You should record the sales. Second scenario, you sell goods and receive the check. When should you record the sales? When you have received the check. Next one, you sell goods on credit. When should you record the sales? When you have sent the invoice to the customer. When you have sent the invoice to the customer. I give you an example where you should not record the sales. Okay, you write down together with me. Write down together with me. Later I answer your question, okay? We write down one example first. Customers place an order. When customer has placed an order, have you received the money yet? Not yet. Have you sent an invoice? Also not yet. Okay, so when customers have only placed orders, you don't record the sales yet. Okay, as far as doing accounting is concerned, don't record sales. Okay, that's not the point of time you should record sales. Yeah, so let me give you a conclusion about this realization principle. It tells you when exactly you should record sales, when exactly you can record the sales in your accounting. It is the earlier of these two. The earlier of these two. It is either when you have received the payment from customer or you have sent an invoice to the customer, whichever is earlier. Okay, one of you asked me a question. Let me share with the rest, then I answer to all of you so that you know what I'm answering. Okay, you can see the chat box. One of you asked me this question. How come for the sales where we receive immediate payment can't be like the credit customers finally pay off and clear the invoice? Can't be like the credit customer finally pays off and clear the invoice. Because they have money. Why customers pay immediately to us? Because they have money. Okay, there's no reason for that. Because customers are rich, so they pay to you immediately. Those customers who buy on credit, because they are poor, so they owe you money for some time. As simple as that. As simple as that. Yeah, but they still pay back in money. So why do you sell goods on credit? Because probably you trust the customer. Probably the customers have been buying from you for some time. I think you are asking, why cannot be sale cash or check? There are many customers, right? Customers who can pay you immediately, customers who would like to buy on credit. Okay, in what situations would you sell goods on credit? When customers, they buy really a lot. They buy a lot from us. Okay, they buy a lot from us. They buy maybe 1 million units of goods. 1 million units of goods. Okay, probably they are running another business. Okay, they run a business, so they buy a lot from us. We run a factory. Okay, we sell 1 million units to somebody. There are some businesses which cannot get money immediately and pay to you. There are some businesses who cannot get money and pay immediately to you. They have to sell off some of the units to customers first before they can get money. And you see, if you don't sell on credit, to them, what will happen? That means you would have lost this 1 million units of sales. Agree? So that's why you have to accommodate. We have to accommodate some customers who pay immediately. Of course, it's good. We are happy. When you sell goods on credit, of course, there must be some condition also, okay, for customers to owe us the money. Maybe they want to buy a lot. That's why we allow them to be on credit. They owe us money because it's a lot of units, right? 1 million units. If we don't sell goods on credit to them, instead we demand immediate payment, they may go away. The customers may go away and buy from somebody else. That's why we sell goods on credit. You get what I mean? Is that your question? Have I answered? Okay, so there are many good reasons why you sell goods on credit. Okay, why you want to let your customers owe you money? Probably they buy a lot. Okay, they probably buy a lot. If you let them go, then they will look for other supplier. Then you will have lost a lot of sales. Okay, so that's why we sell goods on credit to them. Another reason we sell goods on credit is we have very good relationship with the customer. We have very good relationship with your customer. Probably the customer is your brothers and sister. Okay, of course you would let them. Okay, you would let them to be on credit. Okay, you let them owe you money. Okay. Yeah, so realization principle is about when you record the sales. Now we look at one more accounting principle, which I have not stated here. You write down. Firstly, you look at the next table. Help me to cross off this one. Cross off this word. Okay. And then using the area, I'm not sure where you have extra space. On the same page, 401, there's one last accounting principle known as materiality principle. Oh yeah, let me drink some water. Shall we have a 1 minute break? I have to go to the washroom because I have bought the Zoom license. Okay, I have bought the Zoom Pro version. So you see, you don't have to rejoin anymore. Okay. So if you wish to go to the washroom, you may go now as well. Okay, come back in 1 minute. Okay, we continue. One last principle before we start to do the question. Okay, one last principle is materiality principle. Materiality principle. Okay, this principle, you have to understand the word material. Material here doesn't mean the material that you use to make something. Okay, that's not material, not raw material. This material here, you have to look at this word as an adjective. The word material here is an adjective. Okay. So what does it mean here? Material. Material here means expensive, high in value. Expensive, high in value. Sorry, yeah, it's very ugly. Let me try my best. On another hand, you have to understand what is meant by immaterial. Would be the other way around, right? Cheap, it means cheap. Okay, immaterial means cheap, low in value, low in value. Okay, so write down first, yeah. Okay, write down, and then I'll explain to you how this principle works. Okay, what is the meaning of this principle? Okay, let's see. Okay, I give you two examples. Okay, two examples. Example one, sometimes do you see general expenses? Yes, right? Sometimes you see something known as general expenses, right? So what does general expenses mean? It simply means the combination of many small expenses. So you may write down the combination of many small value expenses. They are small in amount, too small in amount. Small value expenses. Combination of many small value expenses. Okay, for example, you buy a stapler. How much is it? Just a few ringgit, right? Okay, just a few ringgit. So in convert into dollar, then maybe it's just $1 to $2, right? So you see, you try to imagine, you buy many small things. For example, a $2 eraser, a $2 stapler. You buy Starbucks for your workers. Maybe $5. So you try to imagine, do you think it is worthwhile to show this individually in the income statement? That means in the income statement, in the expenses section, you show this individually, eraser, stapler, Starbucks. It would be a lengthy income statement, right? Make sense? Okay, so that's why we have this materiality principle. This materiality principle tells us that for things that are immaterial, okay, so just now I say immaterial means low in value, right? So we say that these are the immaterial things. So these immaterial things is not worthwhile to state them individually in the income statement. And to follow the principle, we are allowed to combine all these expenses and call it as general expenses. Okay, so that's materiality principle. Things that are immaterial, you can ignore showing them individually. Things that are immaterial, cheap in value, low in amount, you can combine them together. That's this principle tell me. That's what this principle tells you. I give you one more example. Don't have to know these examples. Okay? In the exam, they will not ask you for example. Exam questions are quite straightforward and easy ones. Okay, don't worry. Now, materiality principle. Let me try to think what is the example. For example, you buy a dustbin. Okay. Why do you buy a dustbin? All businesses need dustbins, right? Can you name any business that don't need a dustbin? I don't think so. Every business will produce rubbish, right? Okay. For example, restaurants, you need dustbin. So how much is a dustbin? Dustbin is maybe just $3, right? Okay, convert into Malaysian ringgit, maybe $10, 10 ringgit, 10 ringgit. Okay, so $3 for a dustbin. Is it material? It's not material. It is immaterial. Okay. Okay, so it's low in value. It's low in value. Sorry, low in value. Cheap. Okay, cheap. Okay, so what do you think? Is a dustbin an asset? Dustbin is an asset. Is it non-current or current asset? Answer is dustbin is a non-current asset. Why? Because you use it for at least 1 year, right? Let me ask you, at your home, at your house, do you throw off your dustbin every year after you have used it for less than 1 year? Of course, no, right? Okay, unless you like to have new dustbin every year. Okay, so that's why it's an NCA. NCA tells you that assets are the things that you will use for at least 1 year from now. Okay, you use it for a long time, generally. So dustbin is an NCA. But you try to think, you try to depreciate this dustbin, you try to calculate depreciation for this dustbin. Do you think the amount is very big in size when you calculate depreciation? Of course, no. You try to use $3. $3, assume that you will use it for 3 years, divide by 3, $1 depreciation a year, $1 depreciation per year. Is it material? Do you think it's worthwhile to show this $1 depreciation in the income statement? Once again, no. Okay, so for things that are cheap in value, if you remember, we have another depreciation method known as the revaluation method. Okay, not sure if you remember. Okay, you have to refer to part 7 if you've forgotten. So one option would be to use revaluation method. You combine all the small value NCA. You combine all the small value NCA. You combine all the small value NCA. Then you apply revaluation method to calculate the depreciation. Okay, that's one way to solve. Another way of solving this negligible thing, the negligible depreciation is instead of recording it as an NCA, you recognize it as an expense instead. You record this as an expense instead. Write down, yeah, write down. Later I further explain. You record this as an expense instead of NCA. Okay, let me explain again this example. Okay, this example, I use dustbin as an example where we buy a dustbin for $3. So $3 is immaterial, right? It's low in value, cheap. Okay, dustbin is an asset. More specifically, is an NCA. Why? Because you use dustbin for a long time. Of course, you use it for a couple of years, right? The dustbin. And you try to imagine when you want to depreciate, when you want to calculate depreciation for the dustbin, because it's an NCA, you take $3, divide by 3 years. Imagine you use it for 3 years, then it's $1 depreciation per year. Do you think it's worthwhile to show this $1 in the income statement? I don't think so. Okay, it's very low in value. It's not worthwhile to show it as a single line. Otherwise, your income statement would be a very long list, a very crowded income statement. Agree? That's why you have two solutions. One solution would be to use revaluation method. Okay, because that depreciation method is meant for low value NCA. Okay, another method will be to record it as an expense straight away. You record it as an expense straight away instead of recording it as an NCA. Okay, that means you don't show this as an NCA in the SOFP. You straight away show the $3 in the income statement as an expense. Okay, reason is dustbin is immaterial. The value is too small. Okay, that's what materiality principle tells you. When you buy a small value NCA, you can record it as an expense straight away. Don't have to record it as an NCA. That's what this principle tells you. Yeah, so if you have textbook, I strongly encourage you to read on all the accounting principles from your textbook. Okay, because the lines there are good for you to even enhance your understanding. Okay, with these examples, maybe it's not enough, but you have more explanations that are written in clear sentences in the textbook. Okay. If don't have, then you ask from me, I will send to you. I have the soft copy. I can send to everyone now. And never mind, when I send the video over, I will send you the textbook. But don't send to anybody else, okay? Of course, it's illegal to have the soft copy textbook. Okay, now let's see questions. We are done with accounting principles. We still have another set of terms to learn, known as the accounting objectives. Accounting objective. Later, we see the accounting objective. We see accounting principles first. Come to page 403, 403, and then you try this question F. Try this question F. Okay, just try the question F, and then you tell me your answer in the chat box for all the three questions here. F1, F2, and F3. Okay, after that, I discuss with you. I give you 2 to 3 minutes, okay? This is a past exam question, okay? This is a past exam question. I screenshotted and put it here. Okay, I wait for Yixin and Benjin. When Hui is finished. Okay, I wait for Yixin. The second one is the confusing one, the second one. The rest are fine. I thought you would type your answer. Okay. Now I discuss. First one, debited wages. with 400 withdrawn from the bank for personal use. Okay, it's something about drawing. Okay, so it's about, let me see, debited wages. So they should have debited drawings, right? They should have debited drawings. So they have not applied. They have not applied the business entity principle. They have not applied business entity principle. Okay, simple. Okay. Last one. Tato credited sales account with 1,000 after customer promised to purchase the shoes. Only a promise. Have you received payment from customer? Or you have sent an invoice to customer? No. This is about realization principle. Okay. Now we see the second one. Second one. Okay. Tato revalued his premises by 20,000 when the premises next door were offered for sale for 20,000 more than Tato paid for his. Basically, it's telling you the neighboring shop. Imagine you have a shop right now. Tato has a shop right now, and the neighboring shop has a the neighboring shop is for sale 20,000 more than the original price Tato paid. 20,000 more than the original price Tato paid. That means the buildings have increased in value. The premises have appreciated in value. Okay. Adeline, what are your answers? I didn't notice that you have not responded. Okay, I have to continue. I cannot wait further. So what does this mean? Okay, so what does this sentence mean? Which accounting principle Tato has not applied? It is going concern principle. The answer is going concern principle. Reason is this. By revaluing premises by 20,000, that means what Tato is doing? Tato is showing the premises at market value. Tato is showing the premises at market value. Okay, by revaluing premises by 20,000 means Tato is showing the market value of the premises. But does this line tells you Tato wish to close down his business? Does the sentence tells you Tato wish to close down the business? No, right? So Tato should not do so. Tato should still show the value for the premises at the price paid, instead, at the cost. So consequently, we can make a conclusion that Tato has not applied going concern principle. Okay. Okay, Yixin, you have to read the question carefully. 20,000 is not the cost. 20,000 is not the cost. When the premises next door were offered for sale for 20,000 more than Tato paid for his. How much Tato paid for his? They didn't give you the cost. They didn't give you the cost. Let's say the cost is 100,000. That means maybe few years ago, Tato bought the building for 100,000. That's the cost. The question didn't give you the cost. And what is the market value right now? Market value right now is 120,000. Market value right now is 120,000. Yeah. The question say premises next door is only for the market value, I thought. But you try to think, in a row of shops, would the price be different a lot between them? I don't think so. In a row of shops in the same location, they must be for sale at the same value, almost the same value. Okay. There's no good reason that okay, maybe you have another example. Maybe one of the shops in a row of shops, one of them is haunted. That's a haunted shop. Then that's another reason. That's another case. Okay. But generally, in a row of shops, all the shops should be for sale at almost the same price. Okay, that's why Tato go and revalue to present it at the market value. You get what I mean? Okay, that's why we say that Tato has not applied going concern principle. Okay, look carefully. Yeah, question didn't give us the market value. You don't get it. Okay, let me explain again. Assume that Tato bought a shop. Tato bought a shop 5 years ago, and at that time, Tato paid for 100,000. Tato paid for $100,000. Okay. So that's the cost. Okay. The question didn't give us the cost. So we have to assume a certain amount. Tato paid for 100,000 maybe 5 years ago for the shop. Okay. One day, the neighboring shop is selling off, is for sale. Okay. The neighboring shop of Tato is for sale, maybe for 120,000. Okay. The neighboring shop, they are selling for 120,000. So what does it mean? It means that Tato shop should also be for sale. Sorry. Tato shop should also be worth 120,000, right? Okay, that means Tato shop has increased by value over time. So Tato is excited because the value of his shop should also be 120,000 right now, about 120,000 right now. That's why Tato go and Tato goes to his SOFP. Tato goes to his SOFP NCA section premises. Instead of showing 100,000, which is the cost, Tato goes and revalue. Revalue means changing this value 100,000 to 120,000. That's the meaning. But is that what Tato should do? No. This is the market value right now. Tato should not show it at market value, because Tato doesn't tell us that Tato would like to close down his business. Unless Tato tells us that Tato would like to close down his business, then showing this is fine. Showing the 120,000 is fine. But since the question doesn't mention otherwise, we should assume that Tato would like to continue to run the business. That's why Tato should follow this going concern principle and show it at the cost instead, 100,000. You get what I mean? Then okay, if you still have question, Tato revalue his premises by cost value? No. Revalue means you change the value to the market value. Revalue means you show your premises at the market value. Okay, let me explain again using another page where I have more area. Okay, let me draw the rows of shop. Okay. This is a row of shops. Okay. This row of shops is in Wangsa Maju. Wangsa Maju is a town in KL. Okay. So they are in the same row. These 5 shops are in the same row. This one belongs to Tato. This one is Tato's neighbor, Ali. Okay, so 5 years ago, all these 5 shops are worth 100,000, for example, because we do not know the amount. 5 years ago, all these shops are worth 100,000. Okay, so Tato bought them 5 years ago. Tato bought it 5 years ago. Tato bought it 5 years ago. For how much? Of course, for 100,000, because at that time, 5 years ago is worth 100,000. So Tato bought it 5 years ago for 100,000. On today, Ali sold it off. Ali sold off the shop for 120,000. So what is this amount known as? This amount is known as market value. This amount is known as market value. So Tato see the situation. Okay, Tato see this event. Tato see that Ali sold it off for 120,000. Is Tato happy? Of course, Tato is happy because market value of all the shops should also be 100. Should also be 20,000 more. Should also be 20,000 more after 5 years. Okay, all the shops should have increased by 20,000. Okay, because they are in the same location. All the shops should be sold at about the same price. So after Tato has discovered that Ali can sell it for 120,000, Tato went on to open the book that shows the SOFP. Tato changed the value. Tato changed the value of the premises from the original 100,000 to 120,000. That's what Tato did. Tato changed the cost to the market value. Tato changed the cost to the market value. Tato changed the cost to the market value. This is known as revaluation. Revaluation by 20,000. This is known as revaluation by 20,000. So is this the right way to do? Answer is no. This is not right. Because the question doesn't tell you that Tato would like to close down his business. So Tato is supposed to show the original 100,000, the cost, okay, in order to follow the going concern principle. Yeah, correct. Revalue means changing the cost to the market value. Okay, so I think you get it now. Okay. Tato doesn't follow the going concern principle. Okay, I close this, yeah. Okay, so that's it for today. And your homework is this one, D. You do this as homework. Next week, I will discuss. Okay, so have a nice day, everyone. I see you next week at the same time. Bye.